Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So we're going to start with a measure of risk on versus risk off, and we're going to do that by looking at the performance for some of the high beta groups out there, and then look at performance for some of the defensive groups out there. We're starting to see high beta underperform and defensive groups outperform. Then we're going to turn to breadth. We're going to look at the percentage above the 50-day moving average and 200-day moving average for large caps, mid caps, and small caps. And then I'm going to take that one step further, and we're going to look at small cap breadth relative to large cap breadth by looking at the differentials for these percentage above moving average indicators. So we're going to look at a number of perf charts to start off with, and I'm starting with a perf chart showing 7 major index ETFs or broad market ETFs. We've got the S&P 100 OEF, SPY, QQQ, got mid caps MDY, small caps IJR, small caps IWM, and micro caps IWC. And this is performance going back towards that March low in 2020, and we can see some obscene gains. So the red line there is the S&P 100. It's up around 85%, and you can see it's the weakest of the group. But since when is an 85% return underperforming? It's not very often you see that. And then you can see at the top there, we've got micro caps. So this is a very interesting dichotomy here in that you can see the largest of the large are underperforming, if you will, and the smallest of the small are outperforming with like a 140% advance since that March 2020 low. Now I'm going to go back and look at a couple of different time frames here. So the next time frame to look at is from late October, because we had a low on October 30th. We had that surge in early November, and it was up, and away into February. And so this is performance for the same ones, and at the bottom we can see the S&P 100, we can see the S&P 500, and QQQ. And you can change this to histogram format if you need to see that more directly. So the large ones are still lagging since early November. This is like 24, 25 weeks. But still, these are huge gains, 25% in 25 weeks. And then you can see performance is getting bigger when we look at mid caps and small caps, and micro caps are up like 50%. So these ones have been leading since the March low. But now we're going to get some smaller time frames. All right, now we're going to do year to date. And I'll just show the histogram chart. And we see year to date, things are still doing okay for micro caps. We can see the Russell 2000 is dragging its feet a little bit. And I think in general, IJR is usually a better bet than the Russell 2000. But here's where things get a bit different. If we look at performance since March, so I'm going to go to this histogram chart, and there is a huge difference since March. That is a month and a half, and we can see large caps are up, mid caps are up, but then small caps are down. The Russell is down more than IJR, and we see micro caps are down the most. And so if you're looking at risky ends, high beta ends of the market, your small caps, micro caps are going to be at the riskiest high beta end of the market. Beta is a form of relative performance. If something has a beta of 2, that means it goes up twice as much as the S&P 500. So you can see that the lower beta end of the market, the less risk end of the market, QQQ is less risk than IWC microcaps, is up. So we've seen a rotation into large caps and out of small and micro caps. In addition to that, we're also seeing money move into the defensive sectors. So here is a sector perf chart, and this goes back to the beginning of March here. And look at the leading sectors. We have staples, we have utilities, and we have REITs. They are all up more than these offensive sectors over this period. And the weakest sectors would be financials, technology, and communication services. So they're not down. And because they're not down, I wouldn't say money's moving out of them per se. To get money moving out, you need selling pressure, and that means price moves lower. This means they're just up less. But this fact that we're seeing money moving into the defensive end or the yield end of the market with utilities and REITs shows a preference for some relative safety. Now I'm going to look at some breadth indicators coming up here because I'm going to switch over to Amy Broker because that's where I can backtest the breadth indicators. But you do have a number of breadth indicators available on stock charts. Here's the percentage of stocks above the 200-day EMA for the S&P 500, S&P Midcap 400, and S&P Small Cap 600. And then you have the percentage above the 50-day EMA for all three. And you can see small caps are the weakest. Now, this chart you see here is part of a chart list that I put together, the trendinvestorpro.com essential breadth chart list. And it's got 100 breadth charts organized in a logical manner. The first charts explain what's going on here. And then we go down, we have the major index breadth charts, and then we have sector breadth charts. And there is just a lot here to do, and they're already set up for you here. We've got AD lines, advanced decline volume lines, and high-low lines for the sectors, and so on. So this list is available to subscribers of trendinvestorpro.com. This is the main analysis page that you see here. And I was talking about breadth here, which I'm going to talk about now. But if you are a subscriber, then you can click on and get this essential breadth indicator chart list. And there's also a video that describes how it works, the method behind the madness. And I also tested the sector breadth indicators, and the tests weren't that great. I found that normal trend indicators worked as good or better than some of the breadth indicators for the sectors. But that's all available to subscribers. So here are the individual indicators for the percentage above the 200-day. We got small caps in the first window, mid caps in the middle window there, and large caps, the S&P 500, in the lower window. And you can see all of them are above 90%. In fact, we can see the S&P 500, 96.63 is the highest. And, they've been at this plateau, this high plateau level since the middle of December. So there's just been continued strength since the middle of December. And there you can see the S&P 500 moving higher. So this is a longer term indicator, percentage above the 200-day moving average. I generally put a bullish threshold at 55%, a bearish threshold at 45%. So you get above 55%, that's bullish. Because if you use 50%, you're going to get too many whipsaws. You have to have a bit of a buffer in between your bullish and bearish threshold to reduce those whipsaws. You're still going to get them. You can't get around them. There were some whipsaws in small caps. In general, I find small caps and mid caps generate more whipsaws than, say, large caps. But yeah, and you can see here, there's a lot of whipsaws here in mid caps and small caps. But the S&P 500 got bullish there in mid-February 2019, stayed bullish until, and that is late February 2020, just before the COVID crash, it turned bearish. You got a little whipsaw here, that's going to happen, but it has been bullish since the early part of July. So that's basically a bull market here. So we're still in bull market mode for this longer term indicator, but where we're seeing some weakness is when we look at the percentage above the 50-day moving average. Now, this is an indicator that is more short to medium term, and that puts it in kind of the mean reversion thrust category. And so I'm looking for kind of a bullish breadth thrust, and when you get this sudden move, I'll go to the S&P 500. You can see in 2018 you were below this minus 15% level. That showed a lot of lopsided selling pressure. That was bearish. And you can see it started there in October 11, 2018. and there was a decline. And then you got the bullish breadth thrust there in early February 2019, and that started this advance here. And then you had a bearish breadth thrust there in latter part of, February 27th, and that was coinciding with the other signal in the percentage above the 200-day. And then we got the bullish breadth thrust there in April, and we've been bullish ever since. Actually, that's May when we got the bullish breadth thrust. But what we're seeing currently is all three indicators are on bullish signals right now. You can see the green, but we can see small caps, the percentage above the 50-day move below 50%. And it's the only one that is even near 50%. So there's a lot of weakness in small caps. And so what I want to do is I want to take this one step further. I want to subtract the percentage of small caps above the 50-day from the percentage of large caps above the 50-day, chart it, and see what signals we get. So now keep in mind that when you're plotting a differential, this is the difference between the percentage of S&P 500, S&P 600 stocks above the 200-day, less S&P 500 stocks above the 200-day. So we've got these green and red arrows here, and that's when it turns positive and negative. So you can see it was negative, and then in April 2018, it turned positive and stayed positive through this advance, and then turned negative. And this is IJR here. So you can see a lot of small caps below the 200-day here in the third quarter of 2018. Now, what's interesting here is we get this one impulse move into positive territory in December 2018, right at the low. So that's an interesting little catalyst to watch out for. But right now you can see it was deep red after that. It didn't last long, and small caps kind of meandered along. And then you had this big COVID crash here. And right at the March low, we had another little impulse with a few days where there were more small cap stocks above the 200-day than large caps. And then back to red, where large caps were leading with more above the 200-day. And small caps kind of dilly-dallied around here. But they really caught fire there in October. And then you can see in December, it turned green. So we had more small caps above the 200-day than large caps, and it stayed green until now. And now we have more small caps below the 200-day than large caps. And so that is saying that small caps are out of favor right now. And to prepare for at best a correction, at worst, some sort of a pullback, or at best underperformance. At worst, a correction or a pullback that could retrace part of this big advance. So I just have a few seconds left here, but we can see that the percent differential got above plus 10% there at the end of October, and that gave way to the big outperformance from small caps. And now we can see that that performance differential got below minus 10%, and it's below minus 30%. So small caps are seriously lagging as far as breadth is concerned. And I put that as a message to stay out of small caps for now. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.